Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me is Gabe, Lettieri, Director of Insurance Sales at Bank of America Securities. Gabe, it's great to have you with us. Welcome to Trade Talks.
Oh, thanks so much for having me, Jill. Looking forward to our conversation.
Last time I met with Bank of America, your team had developed an innovative index that is designed to manage risk intraday, the Nasdaq FC index, which aims to react faster to market conditions with the goal of mitigating drawdowns. For today, I'd like to start by building upon that topic. How else does intraday data add value in financial markets?
Sure. So I think I would just start with this concept that markets have fundamentally changed over the past decade. The rise of passive investing, you have falling market depth, central bank liquidity with zero interest rate policies, and even more recently, the meme stock phenomenon have contributed to an increasingly fragile market. So in this environment, the use of high quality intraday data is increasingly valuable and common. And a couple of examples I'll give you is that intraday data really enables high frequency trading and automated market making. And these are things that we now see in asset classes like corporate bonds that were traditionally viewed as less liquid.
Bank of America's fast convergence technology applies intraday trading and analytics to rules-based volatility management. How does this potentially improve upon traditional volatility control?
Sure. So traditional volatility control really only measures volatility using the closing prices of an asset. And typically it only rebalances a response to changes in volatility after a 1 or 2 trading day lag. Now, given the speed at which markets move today, this lag might expose investors to a more sudden market drawdown. So by responding and measuring volatility throughout the trading day, the fast convergence technology really aims to reduce that exposure to the market when markets are pulling back, but also still enable you to capture positive performance. So if we actually look at the application of the fast convergence technology to the Nasdaq 100 index, for example, when we looked at back testing and actually live data as well, you saw that the application of FC technology resulted in annualized returns of about 11.6% per annum. And if we contrast that against a traditional approach to volatility control, those annualized returns were about 8.9%. So by responding more quickly, you saw about a 30% increase in annualized returns.
Let's take a deeper dive into applying intraday analytics to respond to volatility. Why is it important to apply intraday analytics to volatility management?
Sure, so that's a great question. And there's actually strong intuition and academic research supporting the use of intraday volatility and intraday data, in fact. So maybe just to take a step back and think about what is volatility itself. It's actually a measure of how much an asset price changes. And then you get some intuition around if there's a sharp market drawdown, then that by definition is a volatile event. Even zooming out and stepping back a little bit further, if we look at historical data, we'll find that protracted down periods in the market or market drawdowns have typically coincided with periods of elevated volatility. And it's these concepts that actually form the basis for the introduction of volatility control over a decade ago. What our team wanted to discover or think about, could we identify changes in volatility sooner? And if so, would that have an impact on the outcome? And would it be an improvement upon traditional volatility control? So if we think about the performance measures I referenced earlier, you could see there's a pickup there. And this is coming from both sides of the equation. One, it is more quickly responding to increases in volatility, which may reduce your exposure to a drawdown. But also, when the market's normalizing and volatility is coming in, it's also responding to that more quickly and re-engaging with the market. So overall, these findings are really backed by both research and empirical evidence, and they show these 2 characteristics of volatility that are important. 1, volatility tends to cluster, and 2, it has a long memory. So if we can identify these changing patterns more quickly, we think that there's a consumer value there and a potential to have, the increase in performance that we saw in the back test and even more recent live data.
And Gabe, to wrap up here with the fundamental changes in markets and historical outperformance of intraday technology, where do you see this technology going?
Yeah, we definitely see an increasing use of, high frequency data in financial markets. We expect that to continue. The application of our patent pending fast convergence technology and its use in the Nasdaq FC index is really just one example of a recent innovation. And I would kind of go back to the examples I used earlier, but advances in program trading, advances in automated market making, all these things have moved beyond what was traditionally the most liquid markets, let's say like FX or equities, and now into these other corners of the markets that were traditionally not viewed as liquid, like corporate bonds. Here at Bank of America, our team continues to work on innovative solutions that leverage both intraday data and fast convergence technology. And we really think this is just the beginning. So we're really excited to see what the future holds.
All right, Gabe, appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.